For insight into global markets, I'm joined by Jeffrey Kleintop, the Chief Global Investment Strategist at Charles Schwab. Jeffrey, it's so great to be with you today. So let's start out with this. How would you describe or characterize the global impact of U.S. tariffs as it stands?
Well, Diane, last week we added to the updated forecast we've been getting from global economic organizations like the IMF, the OECD, the World Bank, and the World Trade Organization. All of them have lowered their growth outlook for nearly all countries and regions since the last forecast update, which was around the start of the year. The overall impact for the global economy shaves about 0.5% off of 2025 GDP. The biggest hits were to North American economies, but the IMF did not forecast a global recession. In fact, the only country they forecast to have a negative GDP was Mexico, negative 0.3%. That's basically flat. Given that country's dependence on exports to the US, it's hit pretty hard. But not only is there much we don't know about how tariffs evolve from here, it's also important to take all these theoretical estimates of the impact of tariffs on the global economy with a big dose of reality. What I mean is we don't know how successfully the tariffs will be avoided, but we do know there'll be efforts to do so. The incentives to avoid tariffs are super high. China tariffs are over 100%, but only 10% or less on neighboring countries where Chinese businesses have some subsidiaries. And one way they can do that is by transshipping from China to Vietnam or other countries on the way to the US. That's one way they can avoid paying those really high Chinese tariffs. And the data shows that Chinese companies have been increasingly doing this. Another way is to under-invoice the value of Chinese goods. The value of imports claimed in the US has gone from being above what was claimed to be exported from China, which was over-invoicing to get money out of China and avoid capital controls prior to those tariffs back in 2018 and 2019, the Trump 1.0 tariffs, to now being more than 100 billion below, reflecting under-invoicing in the US to avoid tariffs. Now, in percentage terms, Diane, this means that already 20% of the value of China's exports to the US are not being accounted for in the US imports data. And if we combine that with what I calculate for transshipping to the US, it's possible that nearly 50% of Chinese company exports to the US are already avoiding the bulk of the tariffs. So there are real world considerations to these theoretical forecasts that matter to us as investors in trying to assess what the hit to growth may actually be.
Let's talk a little bit about that avoidance strategy that you just talked about. When I think about it, it reminds me of when you're sometimes trying to take a shortcut home and it ends up being longer and it just, it's just not as great as you expected. When you extrapolate that to, the avoidance that you speak of with regard to China's goods, especially, and China's economy, would it still suffer?
Yeah, you're right. I mean, the tariffs are likely to have a negative impact on China, but China's looking to boost domestic growth as an offset to weaker trade with the US. About half of China's GDP comes from consumer spending inside China. Only about 3% comes from direct exports to the US, with maybe another 3% coming from the indirect exports to the US that I just talked about that pass through other countries or aren't otherwise accounted for directly. So clearly, 50% versus 6%, domestic spending is a lot more important to growth. And if they can boost it meaningfully, it can more than offset falling exports on overall GDP. China's growth last year was around 5%. Most of that was exports, not consumer spending, which has been very soft, kind of at recession levels. So if consumption can rebound this year, it can offset a slide in exports, and that's the plan. China has three budgets: the government funds budget, the state capital operations budget, and the social insurance budget. If we combine them all, it results in a plan to spend 11% of GDP this year. That's a record. So far, spending in Q1 was not much greater than last year, so we're not seeing full-scale stimulus being enacted just yet, but they were likely waiting to see what the April 2nd tariffs look like. So it's the incoming data we're going to be watching, and China's stock market is up about 10% this year per the MSCI China Index measured in dollars. That's widely outperforming the US S&P 500, and that's helping lift emerging market stocks post gains this year so far, despite China being in the tariff crosshairs. China also, by the way, outperformed in 2017, the first year of Trump's first term, and the market's been more volatile this time, but been on a rising trend.
Let me ask you this earnings season, one of the patterns I'm noticing on earnings calls, the analyst calls, is the word uncertainty because of the macro picture. And, you even have some companies pulling guidance for this year. What are you noticing about the impacts of tariffs on business operations this earnings season around the world?
Yeah, a lot of business leaders are being conservative and taking down their numbers. I wouldn't say they're being overly pessimistic here. They just don't know. There's so much that's unknown. We've seen shipping numbers this past week, last week, the number of containers coming into West Coast ports from China was double what it usually is. It was up 50%, but it's about to drop off over the next few weeks. It's really coming down because those last shipments that were ordered ahead of those tariffs have now arrived. Inventories have been stocked up, and now we're really starting to see a pullback that could eventually lead to some shortages, all kinds of issues if these tariff issues aren't resolved. Global economic think tanks I mentioned, the IMF, OECD, World Bank, they only see a moderate hit to GDP growth, but earnings might be a different story. Earnings are much more exposed to trade. Big businesses generally that populate the indexes are multinational. They have a lot of international sales, and U.S. import tariffs have been mentioned on nearly every earnings call I've listened to. The number of companies in the S&P 500 with downward revisions is similar to what we saw in the 2008 global financial crisis and the 2020 pandemic. So it's like a crisis level of business leaders bringing down their estimates. But the number of downward earnings revisions for non-US companies, they're up, but they're far below past crisis peaks. And that may be because non-US earnings are just less exposed. Even in Mexico, I mentioned Mexico's GDP is expected to be negative this year due to the tariff impact, but despite that forecast, Mexico's stock market, one of the best performers this year, not seeing widespread earnings downgrades either. In fact, the stock market's up 22% in dollar terms in Mexico this year. That's because most of the companies are just not exposed to tariffs. It's like Mexico's Walmart and its Coca-Cola distributor and its telecommunications company. They don't really have any trade or tariff issues. So those earnings are insulated from tariffs in a way that economic growth is not. And that's, again, an important distinction for investors, and it's why the earnings outlook remains brighter overseas.
So let me ask you, that begs the question about the outperformance that we've been seeing globally compared to the U.S. You mentioned Mexico, but of course, we've seen some gains in Europe as well. When you think about this global performance, especially compared to U.S. stocks this year, do you expect those patterns to continue, or do you expect it to kind of return to what we've seen previously, that story of U.S. exceptionalism?
Diane, no, I think it's going to continue. I think international stocks will continue to outperform. Our outlook for 2025, published late last year, we forecast international markets would outperform this year, and they have not let us down anywhere you look. And we continue to favor international diversification with an emphasis on Europe. European stocks, as you mentioned, have recovered all of their April 2nd Liberation Day losses. You can see in the chart that we put together, that's not true for the U.S.'s S&P 500, and that isn't simply because of the poor performance of the U.S.'s Magnificent Seven. It's because you can even see it in the equal weighted indexes, which show what the average stock is doing. They're showing a similar gap. So that illustrates it's not just a handful of mega cap stocks that account for the difference in performance. The average stock in Europe is outperforming the average U.S. stock. And it's worth pointing out that this isn't new. I think this is part of a longer term trend. International stocks have outperformed since this current bull market began 2.5 years ago in October of 2022. Sure, they've widened out this year, but they've been performing well for a while. And international diversification is really paying off for investors. I often get asked, how much international should someone have in their portfolio? And my answer is always the same. Probably more than you have now, since so many people have let their portfolios become more and more US and tech concentrated over the past decade when international wasn't performing well. But it's not too late, Diane, to rebalance back into international stocks even after this run of outperformance.
Okay, I'm glad you mentioned that perspective, and I'm glad you even brought up the mega cap perspective, the tech sector. What sectors, though, look best positioned to weather the volatility that we've been experiencing of late?
Generally speaking, more defensive stocks tend to do better in periods of high volatility. But what you get along with that is then maybe not catching up on the upside. What I found is that across sectors, companies that have more domestic exposure, less border exposure, less tariff risks, are consistently doing better both on up and down days. For example, if you look within the European universe of stocks, yes, they're outperforming, but those that are more domestically focused, which includes companies like energy and utilities and financials, which are more domestically focused, they are tending to outperform relative to more export-focused businesses like apparel or footwear or even technology. So focusing more on domestic exposure seems to be a winning bet this time.